Hey, good afternoon and welcome. My name is Matt Price. I want to say thank you for coming to discuss here for the next 30 minutes or so what a retirement planning timeline might look like. So, Randy would be on, but he has lost his voice and sends his regards. But a little bit more about who we are. Randy Price, he tried to tell you he's my older brother. He's actually my father, myself, Matt Price, and then our third advisor, Matthew, goes by Matty Kearns. We make up the Price Group. We follow a fiduciary standard. We think that's really important, and we have a niche in retirement. Over 80+% of our clients are retired. We think retirement, it's really important to have a specialist. Having a generalist, maybe to use a doctor analogy, a doctor that looks at gallbladders on Monday, hearts on Tuesday, and shoulders and knees on Wednesday, it is not a good physician if you have a heart issue typically. Typically, you want a physician who specializes in that heart area. We think the same holds true with retirement planning. So that's how we've positioned ourselves and been really humbled to have quite a few families entrust us over the years with their retirement savings. So with that being said, a little bit about our firm. Randy has quite a few awards from Barron's, Forbes, Financial Times. Our team recently got an award from Forbes. I've had an award from Forbes as well. All that being said, we think the real important thing, though, is education. All three of the advisors on our team are certified financial planners. That's kind of a cornerstone of who we are. Randy and I both went to the Wharton School of Business to get our CIMA, Certified Investment Management Analyst designation. We think that is important as well. So looking here at the dozen or so names that are in attendance, I think most of you are on our Retirement Insider weekly email. But if you're not, shoot us an email and let us know. We'd be happy to add you. But a little bit about our firm, and then we'll get going. Steward Partners, based off the biblical definition of stewardship. The firm as a whole, we operate as a fiduciary, like I mentioned. Think that's very important. Our primary custodian is with Raymond James, so that's where client assets are held. We do have a few other options as well, but most clients have their money at Raymond James. They've been a good vendor partner of ours. So let's take a look at our agenda. And like I said, if trains run on time, we should be 30, maybe 35 minutes or so. And happy to take any questions here in the presentation or offline as well. Typically, we get most of our follow-up questions by the way of email after the presentation or a phone call. But today's agenda, let's look at retirement planning 2 to 5 years out. We will transition into what planning can look like less than a year away, and then is planning really even necessary after retirement? We'll talk about that as well. So let's start with 2 to 5 years out. We think the biggest thing is look before you leap, and creating an overall a retirement plan we think is paramount at this stage of the game. The old saying here in Houston, with a lot of our clients being from some of the larger integrated oil companies, you don't always know when you're 2 to 3 years from retirement. So we think doing this when you are or could be 5 years from retirement, creating a holistic, comprehensive game plan for what retirement could look like is very prudent advice. Part of our process is we develop what we call a live well plan in addition to the family index number. And this family index number is peculiar to each family. So it's not some cookie cutter arbitrary number that we just slap on a page. This is really honed in and tailored to the needs, wants, wishes, and desires of each family that we serve. So that, along with looking at retirement plan contributions, allocations, do we need to make a change in the savings plan? A big one is how much risk are we taking in our 401k or our savings plan? Most everyone we talk to at this station of their life says they're a conservative investor, quote unquote. Yet sometimes we'll study certain 401ks at work, and they're 100% invested in international stocks or small stocks, or even maybe just the company stock, which one could say that typically is not in line with calling yourself a conservative investor. Number 4, considering what it looks like if you do have a few negative years leading up to retirement. That's important, part of our Live Well plan. And then we think this is actually the best time to consider hiring someone who specializes in retirement planning. You know, the most planning actually happens for retirement, leading up to retirement. There's a whole host of things that go on after that retirement date. Retirement's not an event, it's an ongoing process, but there is a lot of planning that goes in on the front end. So we think having someone on your team 2 to 5 years out is like I said, prudent advice. Another question to consider in this time period of 2 to 5 years from retirement is your spreadsheet adequate? And, you know, Randy and I have a joke on who has the best spreadsheet that they've brought into our office, and we've seen some really excellent spreadsheets. You know, the one that Randy likes to tell the story on is the gentleman brought actually a magnifying glass for himself, his wife, and then for Randy and me as well. And we each had a magnifying glass kind of staring at this huge piece of paper that covered about half of our conference table. And so spreadsheets are good. They do a really good job while you're working. One could make a compelling argument, though, that in retirement, spreadsheets are inadequate to do the type of planning that we think is necessary. And here is just a real high-level example to maybe prove why. When we see most spreadsheets that are brought in, they're using a static rate of return. So what if I got 5% rate of return per year, every year in retirement? Now, most people will say, hey, I know I'm not going to actually get that. Some years I'll be a little bit below that. Some years I'll be ahead of that, but we'll just average 5%. And while they might be right in the average, what they're not taking into account is those drawdowns, those negative periods, and the kind of where it bites you most, per se, is early on in retirement. So 4 boxes here that we're looking at. The 2 left boxes are pre-retirement, or while you're still working, what we call still being in the accumulation phase. You start with $100,000, you get a negative return in the first year, a good return in the last year, same returns in years 2 through 9, and you end up with $188,000. Now, once again, still working, but let's look at those returns in the opposite order. Having your good return in year 1, your poor return in the last year, you can see you get to the exact same spot, $188,399, while you're still working. However, there's a stark contrast to the 2 boxes on the right here, which represent the distribution phase or represent retirement. And so having a bad year with your first year in retirement returns, same assumptions, we're just taking out $10,000 a year, you run out of money somewhere between years 9 and 10. But you have the same returns, but that bad return comes in the 10th year of retirement. You get to year 11, still have over $52,000 left in your retirement account. The point we're trying to make here is the sequence of returns have a dramatic impact in retirement when they had little to no impact while you were still working. So because of that, we think it's a pretty compelling argument to say, hey, the spreadsheet's done really well for the past 30 to 40 years, but moving forward, we're going to recommend what we call Monte Carlo simulation, or showing you going through retirement 1,000 times and coming up with a probability of success opposed to just the static rate of return. A much higher hurdle, or it's a much more conservative way to look at retirement. But this is something where we don't want to really, kind of be on a knife's edge on, is this going to work or not work? We want the law of large numbers, statistics, mathematics in our favor before we ever would counsel a family to retire. So with that being said, we'll talk about it in a little more detail, but Monte Carlo simulation, that's a big part of what our Live Well plan does include. 2 to 5 years out from retirement, we think you need more than just an investment guide. And that previous slide is one piece of that overall conversation: retirement investments, insurance, cash flow projections. You know, the cornerstone to any successful retirement, we think, is estate planning, and then obviously the tax planning. We don't file tax returns on the behalf of client. If you want tax advice, we're going to always bring in your CPA. But we do have a lot of strategies that we put in place to optimize the efficiency for clients as it pertains to taxes. We have a few specific examples of how we do that, which we'll talk about here in the next 20, 25 minutes or so. So love this quote from Benjamin Graham, who's Warren Buffett's mentor. The best way to measure your investing success is not whether you're beating the market, but whether you've put in place a financial plan and behavioral discipline that are likely to get you where you want to go. And what Benjamin Graham's saying is, hey, do you have a game plan for your retirement? And so we think it's prudent counsel to do that. If you have a plan, we think it's sometimes good actually just to get a second opinion on that. So leads the question, what should a retirement plan include? I said earlier, retirement is not an event. We think it's an ongoing process. We are updating our retirement plan. We call it our Live Well plan on a regular reoccurring basis for clients. So we don't just do this once and then kind of put it up on the proverbial shelf and dust it off every 7, 8, 9 years. We're looking at this, our team is multiple times a year. We're discussing it with clients at least once a year, typically more than that. But we think we're answering the questions here. How much can you spend? How long will your money last? What rate of return do you need? And then a key question, how are we going to invest in retirement compared to how I've been investing all these years while I've been working? And we see so many different shades of gray, so many different flavors of ice cream with how people have invested over the years. But I would say the general theme is they've invested for growth. And that makes sense, right? You're paying for your lifestyle through your salary, through your bonus, through maybe potential stock grants, restricted stock units, etc. And the money you're putting aside for retirement, your goal is just for it to grow. But where you're in this 2 to 5 years, you need to start transitioning your thought process to how are we going to produce income in retirement. And so that's a big thing for what we do here is everything we do is predicated on producing income. Dividend stocks, private credit, if that makes sense, individual bonds, the list goes on. But we will present during this Live Well plan what an investment portfolio looks like. We obviously will include our transparent cost structure when putting together a Live Well plan as well. But mentioned the family index number earlier. We're solving for what rate of return we think the family needs, but we're doing it with the least amount of risk possible. Now, we don't know what we don't know. And what I mean by that is no one knows what the future holds as it pertains to risk within the bond market, the stock market, any of markets where you do invest. So we have to take some type of risk to produce income, to produce returns, but we want to try to optimize that where you're taking the least amount of risk necessary. Now, some families will say, you know what, I'm okay taking more risk. Our goal really is to take some of the income, but grow this for the next generation. And that's great. Let's set that up accordingly. But we want some of the goals for each specific family to really govern what type of thesis, per se, that we're going to put into what investments we recommend for family by family. So we like in these type of educational webinars to throw in a few maybe very practical ideas that you could implement. The first one here is an alternative to a Roth IRA contribution. Most people that we talk to, they are making too much money to put money directly into a Roth IRA. And so that number is for a married couple, call it 170, 180,000 round numbers. It tweaks a little bit higher year over year. What you can do if you are making more than that is you can put money into a non-deductible IRA, very important, non-deductible, so you don't get a tax benefit from that. You can do that on a Monday, put in $7,000. If you're over the age of 50, you can do $8,000. The next day, do a Roth conversion for the full amount. You're only taxed on the gain. In this example, though, there's no gain, right? You're converting the entire amount. And that's how you can get money into a Roth IRA above that income limit. Now, the way you can stub your toe is not paying attention to what we call the pro rata rule. If you have any other pre-existing IRA dollars, you have to take those into account when doing this. And you can't just, you have a $1 million IRA, you can't just convert this $7,000 or $8,000 account in a silos. You have to take it into account, and the math typically doesn't make sense if you have more than a $50,000, maybe $75,000 IRA. So with that being said, the 401k, which is first cousins to the IRA, our understanding, and most CPAs will agree, those dollars do not factor in for the pro rata calculation. Confirm that with your CPA, but that's our understanding in there. So that is idea number one. The idea number two is relatively similar. A lot of the savings plans or the 401ks that we see with clients within their employer have an after-tax option, not to be confused with a Roth option, but an after-tax option. So a lot of plans will have a pre-tax option, a Roth option, and an after-tax option. You can add these after-tax dollars. The limit's a little bit less, call it $14,000 round numbers. That number will fluctuate a little bit higher most years. But you can take those after-tax dollars, what you contributed, and roll the contribution dollars into a Roth 401k. So you can do that on an annual basis. We also see it where people come to retirement and they've accumulated, making a number up here, $100,000 of after-tax contributions. Those dollars can also be rolled into an IRA at that time. So have that in the back of your mind. Roth IRAs in retirement are the best thing since sliced bread. We think that is the best place to have money, just from a standpoint. The dollars don't grow tax deferred, they grow tax free. So we're still kind of within this 2 to 5 year time frame. We think it's time to evaluate your risk budget. How much is invested in stocks? What would a big decline do to your portfolio? Would it push your retirement back 6 months, 12 months, 18 months? And most people don't want that. So we say we want your portfolio to be retirement ready in this 2 to 5 years out from retirement. We want your portfolio to look like what it's going to look like in retirement when you're 3, 4, 5 years from retirement, to really hedge against this. This image here is maybe a good example of that. Draw your attention to the purple line. This is from year 2000 through 2015. The market was down about 47%. The market was up about 100%. The market was down 57. The market was up about 200. Now, that's the overall S&P 500. Compare that to the green line. And what we've said is, what if you're just down half as much, but up half as much? And you can see you actually, in this time period, end up further ahead, just being down half as much and being up half as much. The point we're trying to make is, if you reduce that risk budget by a little bit, you still participate in the up markets, but that downside typically is going to be more muted when we look back at history, which is what we're really wanting to solve for in the few years leading to retirement. And I said earlier, we think this is the time to consider hiring an advisor. Here's what, over the last 30 years, what some of the numbers have looked like. The average equity fund investor has dramatically underperformed just stocks in general. And the same actually holds true in a greater fashion for the average fixed income fund investor compared to just the bond market. So we think having someone who can make real good bona fide decisions, taking the emotion out of it, is something that is in your favor at this station of your life. So let's transition to less than a year out from retirement and see what the type of planning is we need at this point. This is when we're going to ask you to really roll your sleeves up and figure out, hey, within that Live Well plan, we've said you're going to spend, pick a number, $12,000 a month. Is that realistic? Do you feel comfortable with that? What does that look like? Does that include gifts to grandkids, to kids? Is that something where maybe we need to make sure we're not eating out as much and trying to live within that $12,000 per month budget in this example, leading up to retirement, to see if that is possible? The pension versus lump sum decision, that's one of the biggest financial decisions you'll make. If you have the luxury of having a company pension, are you under 59 and a half, older 59 and a half? We recently had a client retire in their upper 40s, which is a lot of fun for us, but it makes the planning a little more peculiar, a little more specific to that family, and really kind of digging your claws into what a retirement income strategy looks like. How are we going to be producing income? Is it going to be from our Roth dollars, our pre-tax dollars, our after-tax dollars? How do we really marry those strategies together? Ordinary income tax versus capital gains tax can play a big part in that. And, number 5 is a big one, monitoring the retirement plan discount rate. We think it's important to work with someone who is a retirement specialist from a standpoint. They pay attention to a lot of the companies in the city of Houston that have these discount rates where retiring from quarter to quarter or year to year, there can be a material impact based on what interest rates are doing. Including in the Live Well plan, we want to make sure we're including inflation. We think inflation in retirement is kind of like a hidden tax. You sometimes will forget it's there, but it's really cannibalizing a lot of those future dollars that are earned, whether you realize it or not. Randy loves to joke, given the fact he has 6 grandchildren with another one on the way, that the bank of mom and dad is always open. Any big ticket items, new cars, new roof, new AC, what does travel look like, and gifts to family charity. We want to make sure that we're factoring in any and all things into the Live Well plan. A rule of thumb, and there's exceptions to this rule, is we typically see people spending about 70 to 80% of their final year's salary prior to retirement. Now, that's not necessarily true for someone in one of the extremes with a low salary or a really high salary, but that is typically true with that median salary, call it $100,000 to $250,000. That's pretty a good estimate that we can use. There's a recent white paper that has been put out. It's been a few years now, but the tagline was, is 3% the new 4%? And kind of a catchy slogan, but what the white paper was getting at, the research was getting at, is the study of the 4% rule. And just to, I'm sure most everyone has heard of that, is familiar with it. You can see here, there's a study dating back to what we're looking at on the page is 1999. You take out 4% per year from your investment portfolio, and you get 20 years down the road, and you still have all your money left. You've been able to take money out, and the portfolio has actually grown a little bit. Congratulations. Now, the real study was done over the 70s, the 80s, the 90s, into the 2000s, like we're showing here. And what did we have during those time periods? We had much higher interest rates. So interest rates have clicked up here over the last 12 months, but we're coming off of about a decade where interest rates were at or near zero. So one could make a compelling argument, if you think interest rates are going to move lower, that 3% could be the new 4%. So that's not something hard and fast where we're telling every client you can't spend more than 3%, but it depends on the age of when you retire, depends on when you're turning on Social Security, depends on goals for any potential inheritance down the road. A number of factors play in. It is, though, food for thought on how much you take out of an investment portfolio has dramatic effects, maybe not over 1 to 2 years, but over a couple of decades. It's a real material effect down the road. Within this 1 year from retirement, we really want to study the pension versus the lump sum. Obviously, there's pros and cons to each. We see about 80 to 90% of the people from these larger integrated oil companies actually taking the lump sum option. That does not mean it's the right decision for you, but whenever there's any type of planning for multi-generational wealth, them having a goal of passing money along to the next generation, that's obviously a big pro for the lump sum. The other big consideration is, what do you think the rate of inflation is going to be? And if you think that inflation is going to be at or near zero for the duration of your retirement, that company pension is going to be a lot more compelling. But if you think inflation is going to be kind of in the moderate range, call it 2 to 4%, which is what we've seen historically, or even high inflation, higher than 4%, the lump sum allows you to keep up with inflation with more ease. Obviously, the company pension, they set that number and that number is fixed for the rest of your life. So those are the two big considerations. We have an entire piece of this Live Well plan that is geared specifically for helping you compare that pension versus the lump sum, trying to make the best decision for your family. If you are younger than 59 and a half, how are you going to get funds out? We have a number of different options, a one-time distribution, something called 72T, which includes taking the longer of the two. Option 1 would be 5 years, or option 2 would be until you reach 59 and a half. And so you have to take a systematic reoccurring payment in the same amount every year from the IRA for the greater of the two, 5 years, or until you reach 59 and a half. That's a neat way that we've gotten some pre-tax dollars out without that 10% penalty. Net unrealized appreciation is a whole conversation in itself, but that has to do with any company stock with a large gain inside of your 401k, your savings plan. Line of credit, a little less traditional of an option, but it is an option. We see a lot of people go back part-time work. They've been working the corporate grind for 30 plus years, and they retire into outside the city, and they found a fill in the blank, a coffee shop. We had one client go to work at Ace Hardware, and he just doesn't see it as work. He's having a blast doing it, not because he needed the money, because he just wanted to stay busy, and he's a super handy guy. Or just living on some after-tax assets is obviously another piece. But all of this plays into a Live Well plan for your family in this, right now, within 1 year from retirement. A dividend income matters. We've had a few clients say, well, yeah, I understand you got this dividend idea, but do they actually really add anything to the overall return? So we put this together. The gray bar chart is the total return. Total return meaning appreciation plus the dividends. And the blue piece of each bar is what percentage the dividends contributed. And we've broken this out by decades. So what you can see is dividends actually are a real material number as a percentage of the total return. So look at the 70s. Over 70% of your total return came from dividends. When stocks are doing well, like they have for the last 10 years, that number's a little bit more muted. Here so far, 23% in the 2020s, but one could make a compelling argument that over the next 10 years, stock returns might not be as rosy or robust as we've seen over the last 10 years. And if that's the case, dividend stocks we think are a great place for retirees to hang out, just from a standpoint, even if returns are not good, stock prices don't move higher, dividend income is much more reliable and much more consistent than stock returns. So transitioning to bonds to fixed income, here's a look kind of broken out by about 20-year periods. The bottom line is this: bonds have been called safe, quote unquote, investments for a long time. But from 2001 to 2023, if you want to adjust it for inflation, you actually lost money on T-bills. Those are some of the shorter term treasury bonds, and you made about 1% a year on the T bonds. So with that being said, we think it's vitally important in retirement to have a process for what type of fixed income you own. You know, the periods of 1981 through 2000, it was quote unquote easy to make money in the bond market because what was happening, interest rates were moving lower. When interest rates move lower, bond prices move higher. You got a real wind at your back. We don't think that interest rates are going to really be moving much lower over the next 10 to 20 years. Could be wrong, but that's kind of, we think interest rates are going to be more choppy here over the next 5, 10, 15 years. If that's the case, having a strategy for your fixed income is very important. Investing without a process, a real busy chart here, but what we're looking at is the gray line is the overall stock market, the S&P 500, dating back from 1996 through the end of 2019. And the two red rectangles are when the stock market bottomed out at the end of the tech bubble, the end of 2002, which I'm sure many people on this call remember, and then early 2009 at the end, towards the end of the financial crisis, which I'm sure everyone remembers. The blue lines indicate who is buying versus selling stocks during those time periods. And the point we're trying to make is this: the average investor, unfortunately, sells at the wrong time. That's not my opinion. That's just how it's worked historically. And we think that is because people typically, when they're playing with their own money, they get more emotional. They don't have a process. And that's, one could argue, that's okay to do in your 30s, your 40s. But once you're within a year from retirement, we can't be taking that type of risk. And so we think if you haven't already, this is the time to consider having professional help to create an investment process to produce income so we don't stub our toe and do something that could really affect our retirement down the road. So why do you need it? An investment process? We've kind of answered this. Too many emotions can get in the way. Discipline and income generations are at the core of what we do. We think in retirement, our thought process of growing money, for most family, it starts to slowly shift into how do we preserve assets while generating the income we need. So there's a real shift going on with kind of the whole psychology of investing in these few years leading up to retirement. And we just see it time and time again with different families that we've had the pleasure of helping. Here, our last section and the shortest section, planning after retirement. We want to make sure we're consistently stress testing your portfolio for clients. This is a look at what it takes to recover from a portfolio loss. So let's say that your portfolio was down 20% and you were taking out 4% a year from that portfolio. What we're showing here is you don't need a 20% return to get back to break even. You actually need a 36% rate of return just to get back to where you started. And so that's why it's important to really know what you own, know why you own it, how much risk you're taking, because a big key to a successful retirement is just not stubbing your toe with having a real bad negative year in the market. So that's key. A few planning ideas, and this is not a comprehensive list. These are just a few ideas. We like to try to throw a few practical things at you to let you kind of consider holding assets generating income in qualified accounts. This just reduces your taxable income on the after tax piece. Qualified charitable distributions. Right now, your RMDs, required minimum distributions, they don't actually start till 73, but the tax code says at 70 and a half, you can actually start giving away dollars directly to a charity. So this can count towards your RMD when those do start. Gifting of appreciated stock. We did this for a client just this morning. He wanted to gift a grandkid who's in college, not making any money. We gifted from his account about $10,000 to the grandchild. The grandchild's going to just sell that stock. You know, the grandchild will work with their CPA, but they're expected not to have any capital gains from that sale, just given the fact they have no income. Consider Roth conversions when applicable. This can make sense typically after retirement when your income moves lower. It doesn't always make sense before retirement. And then do we want to withdraw anything before it's required? Sometimes the answer is yes, sometimes the answer is no. That's a big part of the Live Well plan. So we think the planning should be benchmarked against goals. We're not trying to outperform some arbitrary index, but we're creating this Live Well plan for families and saying, hey, let's create an investment profile that meets your needs, your wants, your desires for retirement. So with that being said, we would be happy to have you kick the tires. Randy, he sometimes thinks he's an old Baptist pastor. He says that our Live Well plan, we're providing clarity, comfort, and confidence as it pertains to your financial future. And I think he's right. You know, that's really what we're providing for families as they're approaching or currently retired, is this clarity, this comfort, and this confidence that everything is going to be okay if we utilize the correct strategies, if we're using a Live Well plan. So we actually give clients the ability to make changes to this Live Well plan on their own. If you are interested, maybe thinking, I don't want to call these guys yet, go to our website. We have a new page on our website. It's under the tab of how we help prospective clients. And that will walk you through a little bit more kind of what a process of just shooting me an email or giving us a call would look like. We've done our best to be educators. You know, we're not trying to sell you anything. You come into our office, we do a Zoom call. We're not going to try to sell you an annuity or a life insurance contract. We want to do this and try to really add value to a point where you say, you know what, I think I do need to hire these guys. So we've been really humbled. That's really worked well for us, not being sales guys, just trying to you know, do these educational webinars. But it's been a real humbling experience to see a number of families you know, find this helpful and reach out to us. So with that being said, do this, shoot us an email with any questions. Give us a call if you have any. Like I said, I'm Matt Price. That is Randy, Maddie, the rest of our team, Preston, Tiffany, and Melissa from left to right. And we would be more than happy to start a conversation with your family. So, and we had someone ask a question, will this be recorded? Yes, this will be recorded. We send it out by way of our Retirement Insider email. If you don't see that though by chance, shoot me an email. It takes us about a week or so to get it up on our YouTube page. So with that being said, thank you all again for your time. Hope you found this of help. We're 2 or 3 minutes behind schedule, but we hope to hear from you soon. And like I said, let us know if we can be of any assistance. Talk to y'all soon. Thanks.